What if you could replace your entire salary with rental income, and you knew the exact number that gets you there? Most people have no idea, so they guess, and their guess is almost always wrong. The truth is, there is a simple formula. Target income minus operating expenses divided by your expected yield. That number is your answer, and right now, you're about to learn exactly how to run it. Welcome to House Hackers, where we break down the real math behind building wealth through property. Here is the one thing I want you to stay for. Most people who try this calculation land on a number that is either way too high and scares them off, or way too low and gets them into a deal that bleeds them dry. And by the end of this, you will know exactly why both mistakes happen, and the answer is not what you think. Let's start with the shortcut everyone uses. It's called the 1% rule, and it goes like this. If you want a property to cash flow, your gross monthly rent should be at least 1% of the purchase price. A $300,000 property should bring in at least $3,000 a month. Simple enough, right? You can run that number on a listing in about 10 seconds. But here's the problem. Most people find a listing that hits 1% and they think the work is done. They make an offer, they close, and then reality shows up. The 1% rule does not account for vacancies, repairs, property management, taxes, or insurance. It is a screening tool. It is not a full calculation. And if you rely on it alone, you're flying blind into one of the biggest financial decisions of your life. So let's talk about what those expenses actually look like. Property management runs about 10% of your monthly rent. Maintenance eats another 10%. Vacancy adds 5 to 10% on top of that. Property taxes and insurance together can run another 10 to 15%, depending on where you're buying. Add it all up, and you are looking at roughly 35 to 45% of your gross rental income going right back out the door before you touch a single mortgage payment. Real example, a $500,000 property at 1% gross rent brings in $5,000 a month. After expenses, you are left with somewhere between $2,700 and $3,200 in net operating income. That is before the mortgage. Once you layer in a mortgage payment on a $500,000 property, the cash flow can easily turn negative or disappear entirely. That is why the naive answer is wrong. The 1% rule tells you a property might work. It does not tell you whether it actually will. The real question is this: what is the property value that generates enough net cash flow to replace your target income? And that question has two very different answers depending on which path you take. Path 1 is the all-cash approach. No mortgage, no leverage, just straight cap rate math. In a typical market, residential cap rates run between 5 and 7%. So if you use 6% and you want $80,000 a year in net cash flow, you divide $80,000 by 0.06 and you get $1.3 million in required property value. That is a real number. It scares most people off immediately, and honestly, it should make you think twice about stopping there, because there is a second path that changes the math completely. Path 2 is the house hack with an FHA loan. This is the most underused tool in residential real estate for first-time investors. An FHA loan lets you put as little as 3.5% down on a property with up to 4 units as long as you live in one of them. In the bank's eyes, you are not buying an investment property, you are buying a primary residence that happens to generate income. Here's how it plays out. You buy a duplex for $500,000.
3.5% down is $17,500. You live in one unit, your tenant in the other unit pays rent that covers a significant portion of your mortgage. Over time, that tenant is paying down your debt while you build equity and capture appreciation. The capital required just dropped from $1.3 million to $17,500. That is not a rounding error. That is a completely different game. And the income you are generating is not just cash flow. It is the equity building every month, the mortgage your tenant is paying down, and the appreciation that historically follows residential real estate over the long run. The house hack is the fastest path to real estate wealth for most people starting from zero. You do not need a massive down payment. You need to run the numbers correctly and buy a property that actually makes sense. Now, before you go make an offer, there is one more variable you have to account for: vacancy. And here's the thing about vacancy. It is not a worst-case scenario. It is a normal operating cost. Even great tenants move out eventually. Units need to be turned over, and there will be months where you collect zero rent while still paying the full mortgage. The conservative move is to plan for at least 1 month of vacancy per year on every unit you own. That means your cash flow calculation should reflect 12 months of expenses against 11 months of actual rent. Small adjustment, but it's the difference between a deal that holds up and one that falls apart the first time a tenant gives you 60 days notice. You also want to stress test your cap rate assumption, because cap rates move. When interest rates rise, cap rates often expand and property values can drop even if your rents stay flat. A deal that looks clean at a 6% cap rate looks very different at 7 or 8. That is not a reason to avoid real estate.
It is a reason to buy properties that cash flow strongly enough to survive a shift. Buy properties that hit at least 1% on gross rent. Keep operating expenses under 40% of gross rent. Make sure your cash flow covers your mortgage even during a vacancy. That buffer is what separates a property that builds wealth from one that becomes a source of constant stress. So here is exactly how to run your numbers. Step 1, define your target income, not a round number that sounds good, the income you actually need. Step 2, estimate operating expenses at 40% of gross rent as your starting baseline. Step 3, determine your net yield. If you are using the 1% rule for screening, your gross annual yield is 12%. Subtract your 40% expense ratio, and your net yield lands around 7%. Step 4, divide your target income by that net yield as a decimal. $80,000 divided by 0.07 gives you approximately $1.1 million in required property value. If that feels too high, remember the FHA path drops your required cash to around $17,500 on a $500,000 property if the deal pencils. Now you know why both common mistakes happen. The people who get scared off are running the all-cash calculation and stopping there. The people who blow up a deal are skipping the operating expenses entirely and trusting the gross rent number. Neither approach works. The math in the middle is where the real answer lives. Drop a comment below and tell us, are you running numbers on your first property, or are you already in the game and trying to scale? Your answer shapes what we cover next. And if this broke it down in a way that actually clicked, subscribe to House Hackers. We run the real numbers so you do not have to learn them the hard way.